Thank you, Kenneth. As he said, so my name is George Miles. I'm based on the Clarkson's London office. I've been part of the team there for almost 6 years now, of which the majority of the time has been on the FFA options desk. So yeah, we do these talks every now and again. Obviously, Kenneth was kind enough to invite us, and hopefully we can promote some options interest over here and get more participants. How we're going to split it is basically into two parts. The first half is a bit more of a options basics and principles, how they're calculated, how the valuation changes. And then the second half is more practical use cases, real trade examples, option versus FFA, options leverage, all the pros and cons of using them. So hopefully the first half isn't too theoretical. And if you can stick with me to the second half, then I'd like to get a few ideas about trading. So just a quick lowdown on options volume. As you can see, FFA volumes have exploded the last few years, options volumes not so much. When we look at actually trading participants, our active client base is probably about 20% the size of FFA swap traders. So it's a smaller client base. And part of that 20%, probably only about half of them are actively participants trading every day. A lot of people see at the moment as options as an ancillary business or as a secondary interest for them, and probably haven't been educated enough on the real use cases, hence workshops like this. So that explains a lot lower volumes. But also, we've seen an uptick recently. Last year was a bit of a low volatile environment, which isn't particularly conducive to options trading. The last sort of 12 to 15 months, but actually the last 3 months, a bit more volatile and a few new traders and new entrants into the market. We've seen open interest increase a little bit and also volumes. So looking a little bit more optimistic this year than last. So the more interest we can get, the better, basically. Who trades options? So we put it into these sort of four main categories. We've got hedge funds, banks, owner operators, or trade houses. So that's a sort of generic four-way split in terms of the types of clients. And then on the right-hand side, we've got just a very simple chart on the styles of trading that they employ. Any of them can obviously trade however they want, but these are just the most common formats and ways of trading that we see them doing. So in terms of what those different types are, so directional would just be directional traders, only concerned with the market going up or down by placing a certain type of option. Volatility, so they're not concerned at all with the direction of the market, they're just concerned with how much it moves going one way or another. Relative value, so this is the more market maker style. These guys will look to sell options when they think they're too expensive and buy them back when they're available cheaper. And then your classic physical hedging, which can come from owners, operators, charterers doing physical hedging, and also people just hedging just large FFA positions in general anyway. If they don't want to take that position off the books, you can then apply an option strategy in the background, run it in a separate book, and yeah, classic hedge. So what is an option? Let's start at the basics. There are two types. Well, first of all, it's the right but not the obligation to enter into an underlying position. So this means that if the market is going a certain way and it's not the way that you want it to go, then no one's going to force you into that position. You have the right. You can exercise it if it's favorable. If it's not favorable, then it rolls off the board worthless. So you're paying for the privilege for something to happen. If it doesn't happen, then you haven't lost anything other than what you paid. So there's two types of options. One is concerned with the market going higher. This is a call option. And then there's one which is concerned with the market going lower, which is a put option. If you buy a call option, you're buying the right to buy the underlying. If you're buying a put option, you're buying the right to sell the underlying. Obviously, in each case, you'd only do that if the market was at a favorable position. If the market's not in that position, then all you've lost is the premium you've spent for that. A common comparison for an option is a bit like an insurance contract. You're paying a premium for an event to happen. In the case the event doesn't happen, all you've lost is the premium. Obviously, on the other side of this, someone is betting against you. And if it doesn't happen, then they collect the premium. So you can approach from the long or the short side, depending on style of trading. How to interpret these visually in the most basic sense for a call and a put. So on the left-hand side, we've got a call option. So the difference between the x-axis and the horizontal would be the premium spent, because when you spend it, you're initially in a negative P&L. You've just spent some money, or you bought your insurance contract. In this case, we're looking at calls, so we're concerned with the market going higher. As the market goes higher, we come towards our strike price, which is the level at which we go long, or the level at which we go short. That's the kink in the chart. As that comes into play and the market continues higher, our profit from the long call is now starting to outweigh the premium that we have spent, and eventually it will cross the x-axis and realize a positive P&L. And where it crosses, we call it the break-even point. The break-even point is the option strike plus the premium spent. So if I buy a $15,000 call and spend $1,000, although I start making money at $15,000, it's not a positive P&L until I'm over $16,000. I'm not actually making any money until it goes over that point. So that's how to interpret a payoff chart visually. And then we have on the other side, the same for a put. As we know, a put's concerned with the market going down. As the market goes down, on the blue line, the long put starts to show a positive P&L as the market comes lower. Also, by the way, please feel free to ask any questions along the way. I want to make it as much of a workshop and discussion as possible. So if anyone wants to stop me or repeat, that's absolutely fine. Try and appreciate not everyone will be at the same knowledge level. And hopefully you all know a little bit more by the end as well. So how do we arrive at option premiums? As Kenneth said, by the option pricer, everyone has their own. SGX are kindly providing one. A lot of traders and brokers have their own sort of internally built ones, but they all come down to the same 5 inputs. So we put the underlying price is the underlying at 15,000, 25,000. We look at the strike price. So how close does the call or the put? How close to the underlying we want our right to buy the upside or right to sell the downside to begin? Obviously, the closer the strike is, the more expensive. The time to expiry. So are we looking at an April or a May contract, or are we looking at a Cal 27? How long do we have for this option to have a chance of expiring in the money? And then an interest rate component. But then also, as Kenneth said, we've highlighted in red the volatility. The volatility input is the only unknown into the model. So how do we know what volatility to put into the model to find our fair option value or our option premium? All the time, we're trying to think about, for options, what is the probability of this event happening? What is the chances that this strike will expire in the money? Is there a 50-50 chance, 100% chance? It's a consistent consideration. Yeah, just a note there in terms of settlement. FFA options are settled exactly the same as the FFA against the average of all daily index assessments. So at the end of the month, if your strike for a call strike is below the underlying, obviously it will be automatically exercised because you've got the right to buy under where it's settled, and vice versa for the puts. The market settles at 10,000 and you own a 15,000 strike put. Obviously, it will be exercised because you now get to sell $5,000 above the market. So straight away, it captures the difference. So what is volatility? So implied volatility is the market's expectation of future movement on any given contract. So how can we forecast or estimate on any contract how volatile we think it will be between now and its expiry? Tough question. Basically, we will look at the implied bids and offers in the market. There's multiple ways. That's one of them. The implied bids and offers of option premium in the market. Every time someone says a 15,000 strike call, I'll bid $1,000 for that. We can go back to our options pricer. We have our 5 inputs and our theoretical premium. If we know the premium and we know the other 4 inputs, we can reverse engineer an implied bid. If we go back to here, if we have our option premium and the other four inputs, we can put them all back into the model and we can spit out an implied bid or offer for whatever that premium is. So just by pure S&D of where prices are shown in the market, we can backtrack and work out where other people in the market have their own expectation of the future volatility. And just by that in general, you have the markets will create a bid and offer spread on implied volatility. So that's a good general place to start. Other places to start is historical volatility. So we can look back at that contract's past performance over the last 10 days, 20 days, 30 days, 50 days, or we can look at how well it's performed at this point in the year for the last 5 years. Are we in a high volatile environment? We're in a low volatile environment. And just by that comparison and comparing some historical data, that will give an idea as well. So a combination of those two factors are probably some of the traders' main tools that they consider in the market. But obviously the current supply and demand will dictate quite highly as well what makes a difference. If it's a volatile market and a lot of premiums are bid, implied volatility will be higher. So vice versa, if the market's not moving a lot, there's a lot of offers and a lot of option sellers, then implied volatility will come lower. So it's a constant, just like the FFA curve moves up and down based supply and demand and various factors. We have another curve. We have our own, it's called the term structure for options, which is how the implied vol moves up and down across April, May, June, Q3, Q4 calendar. So. Yeah. Yeah. So everyone has their own recipes to a certain extent. Basically, so we're all trading Asian options because we have the averaging component of the market, and the industry standard is the Turnbull-Wakeman Asian pricer. So that's pretty standard. You can get them online or whatever. People will run slightly different models based on things like interest rates. So interest rates at the moment, you might run 4 or 5%. Other places might have a zero financing cost and run 0%. There's a lot of small intricacies, but basically more or less, we should all be relatively in line. Sometimes people run a trading calendar, which is 252 days, because with options, one of the time to expire is a big impact. And sometimes people run a calendar, so of 365 days. So they can spit out different premiums. Obviously, if you're running a longer calendar, the premiums will be lower. So sometimes that can have a slight difference. But between the broking shops and the exchanges, we should all be relatively in line. Of course, sometimes this not always the case. But, so keep going on the volatility note, just a few notes. This is just a quick example that I made sort of to demonstrate if a market is volatile or not. Quite often, I think there's a misconception that the market can go on a really strong rally or a one-directional move, come off quite a lot in a singular week, and everyone is talking about how volatile the market is. Well, actually, when you look at the data and on the option side, it's not particularly volatile. So the first example is just some Cape movements. I think I took these from a couple of weeks ago. The first example is just the general movement, which spits out a historical volatility over the last 10 days on an annualized basis of just under 75%. And example two, I've sort of fiddled with the numbers and made it more of a one-directional move, and you can see how dramatically that becomes an unvolatile market. And in the third example, I've made it a bit more dramatic, and you can see how it's a bit more accentuated and tends itself to a more volatile market. So that's always just something to be aware of. But, yeah. Again, looking back at historical volatility being one of the big considerations for options traders, as it's one of the biggest differences between FFA and options. Just over the last few years, we can always see that one, the market is quite a cyclical repeating pattern. Certain months and contracts throughout the year tend to have a higher volatility, and then it's counteracted by certain other months that have a lower volatility. So across the year, it's actually quite a mean reverting pattern. And then if we refer back to the insurance contract example, just on the two horizontal lines, the higher line being the average of the implied volatility, which is where it's marked, and the lower horizontal line being the average of the actual historical volatility, i.e. where it's performed. So there has to be something in it for the option sellers or the insurance sellers, because there's no reason for them to give away something for free. You wouldn't give away something to the buyer who's going to get it for nothing. So for them, there has to be some sort of mark to market, some sort of edge above where it performed. So that's just an example of why we generally always see implied vols higher than historical vols. And for example, if the market were to pick up tomorrow and over the next 10 days and perform really well, you would see all current option sellers pull back. And then obviously in a year's time, if you looked at the chart, it would all tick up for the current time. Another, I think it's the last observation. Yeah. Another observation. So similar to the FFA curve, most of the movement is seen at the front of the curve. If there's any sort of C5 fixtures, new fixtures, or news around the world, it's the prompt months that react to that. Exactly the same for options. Well, it relays straight into the realized vols, and for options, all the movements on the front. So I think you can see the month plus one is almost 3 times the calendar when I looked earlier. But yeah, the movements at the front of the curve, and as you move further out, the historical volatility is lower, and it's exactly the same for in the implied volatility. That follows the same pattern as we get to the front of the curve. That's where you see the highest implied volatility. So it's not uncommon to see a month plus one cape at around 150%, 180%. It's not there at the moment, but and as you go further out, the calendar might be down at 40%, 45%. So logical. So again, difference between FFA and options. On the FFA, the underlying traders are pretty much concerned with one thing, whether it goes up or down. On options, we have to consider how fast it might go up or down, and whether it goes just up or just down. But most importantly, the speed that it does move around before it gets there. So if you take an example of buying a call option, if an underlying trader buys the underlying and the market goes up, 100% they'll be making a profit. If an underlying trader buys a call strike and the market moves up a little bit over time, might not reach there, it's not a guaranteed profit. So you can't always be assured that it will be there. In terms of the importance of volatility, there's different ways to trade options. Ones that are concerned with the volatility will basically be taking, when you trade a call option, for example, it's like taking a long underlying position. To neutralize that, to neutralize their exposure to the underlying direction, they will trade the opposing trade on the swaps. If I buy a call option and sell the futures at the same time, I now have no market direction. If the market goes up, my call will make money and my futures will lose money, so I'm net zero. Or if the market goes down, my call loses money, but my future short makes money. For the small movements, it counteracts. When those movements become larger, the traders can do something called gamma scalping, which will be repeatedly trading in and out of the futures, which will realize a small P&L each time. That's being a long volatility trader. Not something to get caught up on, but something to be aware of on how some people trade, perhaps. Okay, so how do we actually measure our risk? How do we measure how our options are going to move? The Greeks. So the Greeks are the measure of the risk sensitivities of an option to the movement in various factors. The main ones being, well, the only ones being underlying price, time, implied volatility, and again, interest rates. Each one of these has their own name, for example, and they all have their own sort of set of rules and how they move. The most common one I would say to be aware of out of all of these is the delta. So the delta is basically the options position if it was in the underlying. So if you had a call option with a 50% delta, then if the underlying moves $100, then my call moves in value $50. This is how much it moves each time. So I'll go into delta more, but so we've got delta, which is in respect to underlying, vega, which is with respect to implied volatility, theta, which is in respect to time or decay, people call it as well. They're the three main ones, and we'll go into each very briefly. So as I said, this is the delta, so it's the change in the options price basis a one unit change in the underlying. For freight, we just look at $100. So as I said, if it's got a 50% delta, if the market moves up, then my call option is going to move up in $50. If the market moves down $100, then it'll move down to $50. Pretty much as simple as that. Delta people always also look at as the probability of the option expiring in the money. So a strike, an at the money strike, whether it's a call or a put, will have a delta close to 50% because it's a red or black situation. It could settle just above or just below. It's 50-50 is right in the middle. If we look at strikes further out of the money, so if the underlying is at 25,000 and we're looking at a 35,000 call, it's now got a longer way to go before there's a chance to get there. So we'd say it's got a lower delta, a lower probability of expiring in the money, and it's further away. So for a delta, for a call option, delta is always positive because we're looking if the market goes up, the call's going to be worth more. For a put option, the delta is negative. If the underlying goes up, the chances of our put expiring in the money are going to go down. It's all about our probability of expiring in the money. Yeah, and as I said, so the strike's further away from the underlying, they've got a smaller delta, again, because the chance of it expiring there is a lot smaller. So the next sensitivity is the Vega. This is concerned with a change in implied volatility. People that are inherently long options or long premium are long Vega. So every option will have a Vega assigned to it. And this will change, basis some impacts, but for both calls and puts, it's always positive. If Vega goes up, if volatility goes higher, implied volatility goes higher, the market gets more volatile, option premiums become more expensive. There's more chance of the market moving around. So all options have a positive Vega. If the market's moving around a lot and all the brokers shift up their marks, then it makes premiums more expensive. So Vega is greatest for closer to the money options, and it's also greatest for contracts that have the longest time to expiry. So as we get closer, the Vega gets a lot smaller. The premiums on the front get a lot smaller because there's also less time value as well, which we'll touch on in a second. So there's a small example at the bottom there of how Vega would just affect the general P&L of a book. If someone has various options and different strikes across different contracts and they're long, their whole net position could represent, say, $10,000 of Vega. If all the marks get moved up 1%, then the value of their position goes up $10,000. Vice versa if it goes down. And the last sensitivity to be aware of is theta. So this is quite, I think, probably one of the easy ones to understand. It's pretty intuitive in terms of how long do we have left for the chances of this option to expire in the money. If there's a great amount of time value, you should pay more for it because there's a greater chance we have a greater amount of time for it to come to fruition. So when we look further out the curve, we can see that they erode not a lot of dollars per day. So theta is about the USD value that the option loses per day. So further out, they lose a small amount. Got plenty of time for the option to happen, no worries. As we get closer and closer, what are the actual chances of it expiring? Okay, it's not there, it's not there. This option's now worth less and less. And as you can see, as we move on contracts closer to expiry, it steps up, and eventually becomes a significant amount of the option premium until it basically expires worthless or in the money. So yeah, and another example there. So if you did Q3, 22,500 call for 30 DPM every single day, you'd be losing 1,400. If every factor stayed the same, you'd be losing just under $1,400 in value of the option. Okay. So the volatility surface is an options way of marking different strike options. Because of the supply and demand in the market, sometimes there's more demand for puts than calls, or calls than puts, and also different demand for how close to the money or how far out the money they are. In the options world, we would assign different volatilities to these, and that is why we can mark a surface. So if there is a big demand for, say, puts, as you can sort of see on the left-hand side of the table, we would expect that the puts trade at a positive X amount percentage compared to not only that the money, but also the calls on the other side. So the general takeaway, I think, from the volatility surface is that puts are generally always a premium in the freight market, and lower delta options or lower premium options are always generally in a high demand because they're quite a leveraged it's quite a leveraged trade for people to buy, which we'll go into in the second half. But basically, when options are cheap, it's sort of giving away a free opportunity to someone else. So they're generally quite well bid, so they trade at a premium. But they're the two outtakes to take from the volatility surface, really. And following on from that, we can illustrate the volatility surface via a smile. So as I just said, we would expect the options further away from the money to trade at a slight premium. So if this was the trading level, and that's our at the money, we'd expect the further we go away to trade at a premium. The volatility smile is just simply an illustrated version of the surface. And so that's the smile. And in terms of volatility skew, it's just if the underlying was 25,000 and we traded the 20,000 puts at a premium that implied a higher volatility than the 30,000 puts, so they're both equidistant away from the money, and one traded at a higher volatility, we would simply say there is skew for that strike, or in that case, there would be put skew. So it depends on what strike trades at a high volatility at the time, and we would just say skew there. That's comparing calls and puts. We also have option structures. So I've just given a quick example of a call spread there. So that's buying one strike and selling another strike higher up to finance it. It's an upside trade, a bullish trade. Someone doesn't want to spend loads of premium on an outright call. So they're happy with an upside range. In this case, the at the money, so the 50 delta, 25 delta call spread was applicable to what strikes was it? The 23.32. If we go back and we reference our surface where we marked the calls, we can see that the 25 delta calls, we had a roughly -2%. So the at the money, so they should be trading a little bit underneath. Now, if we refer back to our option sensitivities and how every option has a vega attached to it, we can say that the vega on those, I think it was around $60. Yeah, the vega on those calls is about $60. We've got, if one vega is 1%, then we've got two of those, so about $120. So if someone wanted to sell that and when they looked at their surface, they go, okay, I would charge you $120 difference or over the fair value, because the strike that I'm buying is marked at 2% under 1 year home. That's a very simple example of the skew, but again, there's probably not one to get too concerned with. So that is sort of first half rundown of options basics principles, how premiums come about and how they move in value compared to the sensitivities. I think we're going to have a break, Kenneth, if everyone's still with me. We'll do a quick break, and then so the second half is more about real use cases, trading examples, option versus FFA, and option leverage. So the theory's out the way.
Okay.
Thank you.
Thanks, George. Any question for George?
I don't need questions.
Before we go for a break?
Explain a bit on that.
Which one?
The gamma scalping that you mentioned.
Yeah. Okay.
Thank you.
So we traded a long call, for example. So we'd buy say a 20,000 call, and we traded it with the appropriate hedge. So a 20,000 call on Q3 Cape, so you traded it at a 50-cent delta. So we'd buy 30 DPM of the underlying, we'd sell 15 DPM of the futures. If we think about the extremities of the market went to 50,000. My call is now going to represent a very long delta position, but I only sold 15 days, 15 DPM. So now when we get to $50,000, I'm very, very long. I can now sell a load of futures, capture the difference. And now let's imagine that the market goes to zero. So $50,000, I've just sold loads and loads of futures to bring my net delta position back to zero. Now, if it goes to zero, I've sold a bucket ton of futures at $50,000. I'm going to go all to zero, where my call is now lost all of its delta, and now I'm going to buy it all back, and I'm going to buy and return the position back to zero, or return my net delta position back to zero. So it's all about when the market moves extreme and the delta between the call, or what it represents, and the amount of futures you've traded against it wildly offset each other. You always bring it back down to zero. So I'm now not exposed to the market direction. The market moves a lot in either direction. One will offset the other, but basically being long volatility will force you to either buy low and sell high, or sell the high and buy low. It will force you to do that. It doesn't matter which way the market moves. That's being long volatility. And every time you do those trades, it's called gamma scalping. So people that are long options have to do that every day, because that is what offsets their option decay, the theta. So going back to the theta, where if I just own an option and I sit there and it erodes $5,000 a day, I lose that. So I could choose just to lose that and hope that it goes through the strike, or I could sit there and I'll go, okay, I'm going to speak to my broker or someone. I'm going to buy 10 DPM of swaps at this level. I'm going to try and sell 10 DPM of swaps at $700 higher. I'm going to, well, maybe I'll sell 15 there and keep returning it back to zero. But obviously, for that to happen, the market needs to be volatile. That's why the long premium, long vol players need the market to move so that they have the opportunity to trade those swaps. If they don't have the opportunity to trade those swaps, then they can't capture the moves. And then they just sit there and we say that their book erodes or bleeds. They're sitting on long option premium and every day it loses value. So they only have finite trading time as well, because the option is for a certain maturity. So between that point and then, between buying the option and its expiry, they need the market to stay sufficiently volatile to capture that. And if they do it enough, then it shows a positive, yeah. Testing? All right, Ruby. Okay, I think we've still got pretty much everyone, so that's a result. So the second half is going to focus more on sort of why options versus FFAs, some key use cases, some real trade examples, and just highlight the sort of leverage factor that options can provide. So firstly, starting on why options. So losses are on long options positions, whether you're long or call, long or put, your loss is limited from day one. You know what your premium is spending, you know what your net spend is. It can't get any worse than that. Whereas obviously with the FFA, the market goes against you, you might be forced to stop out and crystallize a loss. Could be a bit annoying. With an option, if the market goes against you, just temporarily the value of the option could decrease, but you still hold either the upside or the downside. So whereas an FFA or an underlying trader might overall be right about their view, the market might come off, they might get stopped out, they might not be able to sustain the position. The market could then retrace and the whole conviction be completely right, but obviously they don't hold it anymore because they've been stopped out. Whereas the option, if you hold it, you've still always got it, and that is your maximum, your worst case scenario. Similarly, if it goes against you, long options, very little margin implication. So unlike posting variation margin consistently on a losing position, it doesn't matter because you've paid your premium. So it's quite a big difference. They can be used to create non-linear payoffs. So options quite commonly are used for settlement trades. Creating a wide range or payoff range for settlement is very appealing to a lot of traders. It's all about their view of a settlement distribution. Where do they think the X contract could expire? Could it be close to the current underlying? Could it be really far away? Who knows? We're using a combination of calls and puts, or just calls or just puts, can create various structures that over this half will sort of visit quite a lot of those. And you can see it basically provides the trader with a lot of flexibility and customization. So it's really up to what your mind can create in terms of what's available to trade. In here, I've actually just put a real example of a trade we saw recently. It was about mid-Feb. Don't worry too much about understanding the whole structure, but essentially it's a downside range, a fixed downside range. So if the market was around 20,000 at the time, so anywhere between 20,000 and 12,000, they make money on settlement. And the trader financed the downside range by selling a call strike. So they thought the market might go down. They weren't super convinced, but they're pretty sure the market's not going to go above the call strike that they sold. Net, they've got a downside range for spending very little premium. And instead of selling the FFA for a bearish view, they've got a lot of breathing room up until 27,000 before they knock into any short position. So that's just a very quick, brief example of how sort of convoluted structures can get. There's more complicated ones and there's less complicated ones, but it's just an example of a range. Obviously, very different to the FFA, more just a one-dimensional up or down. Obviously, again, the volatility aspect of an option, quite appealing. The expressing a view on volatility via various strategies. The main ones are straddles and strangles. They involve either buying both a call and a put, or selling both a call and a put at the same strike. So in this case, like we were saying before, when we're concerned about volatility, if we're doing a short volatility strategy, we want the market to stay still. We want the market to stay in a specific range. What is that range? We can decide, basically. So in this case, this was a real trade placed, I think, mid last year. April last year. So they sold the 27,000 call and the 27,000 put at the same time, received $8,850 per day premium. So almost $9,000. It's quite a significant number for the privilege. And basically it creates this payoff range where they have a breathing room of $8,885, $8,850 on either side of the 27,000 strike. So this point here, if we go back to our payoff, it's going to be 27,000 plus 8,850. And this point on the other side is going to be 27,000 minus 8,850. So it creates that range where anywhere in between is a profitable trade. Again, it all sticks in line with wanting the market to not be volatile. They want it to stay in a specific area and every day collect the premium. So this trade was actually a bit of a cracker for the seller. So they collected quite a lot of premium on the different settlements there. July, August, Sep almost pretty much towards the maximum profit range. So I think between the three settlements for 30 days per month, collected almost $600,000. So quite significant premium. So the last three, so in terms of commercial uses, so we got the losses can be limited to premium spent. We've got non-linear payoffs, and we've got they can be used for volatility strategies, long or short. They're more commercial. In terms of a practical trading approach, options can provide access to larger volume. The swap market has grown a lot now, so volume can still be traded there. But in options, we tend to see no clips smaller than sort of 30 DPM or 30 days really, and quite commonly or frequently trades up to sort of 300 DPM on days, quarters, or even calendars across various structures. So quite often you can see large amount of options volume transacting, but it could only actually represent sort of one trade. Similarly, with the value of option, Salah?
On the volatility.
Which one?
The straddle.
How to manage?
Yeah, how to manage.
Well, there's two ways to manage. You could sell it and shut your eyes. Or you could, when you're selling a call and a put, actually the delta will offset quite a lot because obviously from earlier, the call has a positive delta, put has a negative delta. So actually the net delta position between both combined is quite often not very much. So when you trade like 30 DPM of that, it might only require to trade 2 or 3 DPM of swaps. So actually it is very similar just to sort of trading it naked. If the market moves in one direction, then that will change slightly depending on which. But you can, as we were just sort of referring to, it'd be, if you're from a short position, it'd be the opposite of the gamma scalping. So you'd be being forced to sell low and buy high, or buy high and sell low. Obviously, the objective is to do that as little as possible, because it's not great. But yeah, that'd be how you manage it. And depending on how confident you are with trading the underlying as well, if it's a time where it's sort of forcing you to sort of to sell low, you might sort of, hard to say, like back yourself in the fact that the delta will actually come back your way, and that you don't need to do that trade at all, and it will come back your way. So you can avoid doing the trade perhaps if you sort of understand, if you back your underlying trading. No. So this payoff chart is one call and one put. Yeah. Because so the put is concerned with, so we're short one put, which means we're going to lose money on the downside, and we're short one call, which means we lose the money on the upside. So if it was short two puts, it'd be a horizontal line, and then just a negative line. We go. That's our short put. The dotted line there. So if it was two of those, it would just be slightly accentuated on the gradient on the downward move. But yeah, it's because if you think about it, we're combining the two dotted yellows. We're combining them together with the kink at the same point, because that's our strike price. So when we put them together, there's no horizontal. The downside starts from both, but because we're collecting a lot of premium, it starts quite high above the axis. Yeah, so if you imagine, because the strike price is the same, there's no horizontal, they start at the same point, and then because there's a lot of premium in both, that's why it starts so high up above the axis in the first place, collecting a large amount of premium for both the call and the put. Yeah, so you can buy the call and the put. I'll just give you a sneak peek somewhere. So buying a call and a put at the same time is at different strike prices. It's called a strangle. So in this case, we're buying the put here, we're buying the call. So we're buying the upside, we're buying the right to sell. That structures another volatility structure, or strategy, sorry, which is called a strangle. So we'll get onto that later, but yeah, you can do that. and similarly, you can sell both again, and it still creates a wide range each time. So both times, depending on how the trader wants to trade it, on the volatility strategies, if you're buying it, you want the market to move loads in either direction. You're agnostic to which. Or if you're selling it, you want the market to stay still as much as possible. But we'll come back to that somewhere. Yeah, so sorry. So yeah, it's a large volume. Okay, and then so the drawbacks, as we saw from the volumes, it is a much smaller market. It can be a little bit illiquid, and sort of price discovery can take a long time. There's fewer traders, and as we've just sort of seen, some of the structures can be quite complicated. So it takes a long time for the traders to sort of understand and see if they want to take that risk. Or there's a lot of backwards and forwards discussions between options brokers and options traders, whereas on futures you give the order and that's the number, otherwise move on, sort of thing. Looking at Kenneth. Well, it depends what it is, because some option structures will represent very similar to the underlying. I think in general, options is much less than futures.
Yeah, so depends on whether it's in the money, deep in the money, or out of money. Right? So if you are selling a deep in the money option, then margin tends to be higher compared to the other options. But compared to futures, I guess it should be lower.
Yeah, compared to
Because the
futures,
delta is less than 1. Okay, offhand, I can't answer you. Okay,
I don't think it's exponential, but it would be margin the same way as just being a short FFA at that level, because there's no more risk than that. I think so.
We can do a simulation to come up with the
Actually, well,
requirement.
I don't know if Jeff can hear us. Jeffrey's quite good on trading margin. Maybe he'll mention that at the end.
Sorry, I didn't quite hear the question.
Jeff,
Hello.
Yeah, hi. No, my question was margin-wise. If I sold a call versus just buying outright, is there any difference margin-wise?
If you sold call versus what so what?
I think
just doing something on the underlying bit, just outright.
So
okay.
short FFA or short call margin-wise.
Yeah. So generally, I mean, Kenneth can correct me if I'm wrong, but options are margin on its delta equivalent. So just think about it. So if you sell a 50% option, then the exchange would margin as if you sold the underlying or bought the underlying at 50%. So you sold 30 days, right? Option at the money, 50% delta, then exchange will convert that to 15 days of the underlying futures, right? And then it will margin you based on that. Okay, so exchange will first convert your option into delta equivalent and then margin accordingly, right? So in your example, you said okay, you sold a call, right? Is that what your example? Sold a call and bought it underlying, or what is that?
Just naked, you sold the call naked.
Yeah, if you sold call naked, yeah. So if it's dependent delta, right? So if underlying trading 22,000 and you sold 22,000 call, so the delta is roughly around 55%. Then basically if you sold 30 days, right? Then so exchange will convert that 30 days to 15 roughly 16 days equivalent of the underlying, and the margin as if you sold 16 days of the futures. Does that make sense?
So I think to answer your question, if the market were to continue going on your short calls, it would represent a larger delta, so you would be margined as it increasingly.
That's correct.
That's what you're saying. Okay, thank you, Jeff. So touching on a little bit of physical hedging, TC risk. This is quite a common use case for a few of our owner-operator clients. We see it relatively frequently in terms of them coming to the market as an alternative to just a conversion or a hedging with the FFA. The two main hedging examples that we see, or two predominant use cases, will be people either buying outright puts or people buying a collar. So buying a put financed by selling a call. They're the two most common sort of aspects. And then occasionally, or probably less seen, but short calls is something I think worth touching on as well. So we'll look at these. So again, we've got our payoff chart of a long put. Again, losses limited to the premium spent. I priced these, I think, last week, so the premium's probably still relatively good. But as you can see, 3 different premiums, one starting from pretty close to at the money. It's quite an expensive $4,300 a day put. If the owner wasn't willing to spend that much, or preferred, if they had a maximum spend target and they were looking at a lower strike, then you could shift that down, and the 18K put slightly cheaper, and then the 15 even more so. So there's a lot of flexibility for the owner in that situation to select what strike they're looking at. They might have a maximum spend in their mind of $500,000, $1 million. They might, so. And they'll come to us and they'll go, look, what's the maximum put strike you can achieve with this amount of premium? we can quote them that. And again, the risk of the margin on the long is not there, and no risk of being stopped out either, or the consistent variation margin calls. Obviously, on the downside, it's a little bit capital intensive if someone's not used to wearing or spending that much premium, and that's generally posted up front as well. Also, there is the risk that if the market stays exactly the same, so just comparing it to if they just sold the FFA, if the market were to stay the same, they wouldn't lose anything on the FFA. But if the market was to stay the same when they've bought a long put, then obviously the premium they've spent would be lost. So that has to be a consideration as well. Not that every premium you spend you need to be willing to write off, but how much would you be sort of willing to lose? So the outright puts, quite common, pretty simple, quite attractive. We see that fairly often. Another strategy that we see fairly often as well is a collar. So it's the long put financed by a short call. The payoff for this actually emulates quite similar to a short FFA. So if you sold the FFA, you're going to be looking at a downwards horizontal line from whatever underlying level you sold it at. So we priced 3 different types here, just as an example for premium expenditure. I think I used the same put strike. So that 19.5/26 collar at 19.50. So in our first example, the 19.5K puts were 4,300. Suddenly it's less than half the price just by selling some calls. So the big positive here with the calls, with the short calls and the collar, as opposed to the FFA, is that you actually retain some upside. There's no negative impact from a short position from the short call until you reach the strike. So if you just think about, if you sold the FFA at 90,600 and the market went to 26,000, you'd be offside by almost $6,000. If you did that collar and the market went up, you're still not short until it's gone through that call strike. You still have no risk. You retain an upside. You retain your upside potential to a certain level. After that point, you then do forfeit the upside. It caps how much you can gain, but at least you've got a little bit of extra breathing room, rather than with the FFA, it completely effective immediate will nullify, will be an effective hedge 1-to-1. So, but from a much lower level. So lower expenditure than a put, retains some upside, and there is another variation which can make it even cheaper by selling a lower strike put, but we'll look at that later as well. The cons of this, if the market does shift a lot higher, then obviously you are hedged and your profit is capped. And again, but no different to short FFA, there are margin implications if this goes higher. So how does this collar look against our long TC risk? A bit like this. So the green line is just sort of a simulation of the physical long that we have. The red line is just as one of the collars from the previous page. So that would be an example of the option structure that someone might put on to hedge this. And the blue line is the net position. So as you can see on the downside, you're hedged because that's the idea. We're long the put. We know our maximum downside. And the slanted horizontal along the way up is where we're going to retain some of our profit as the market moves up. And then where it goes horizontal and we lock into our short call strike is where we're happy to cap our profits. But obviously, the main point here is just gives more breathing room, more participation in the upside, as opposed to the short FFA. Now, from an options perspective, we would say that the net position you're left with is a call spread. So it effectively looks like your long one call from lower down, and your short one from higher up. It creates an upside range, and you spend X amount of premium on this. Whatever your premium for your collar is that premium. So final approach, not so much as a hedge, but definitely quite a popular trade for people to do, is just simply selling short calls. Selling short calls, depending on what tenor across the curve and sort of strike price, can actually reap the seller quite a lot of option premium. Call strikes are quite highly valued in the market compared with how the option price works and the log normal distribution of strikes, because of the upside potential in the market, calls are quite heavy premium. So simply selling those as a naked strategy means that if you're selling a strike that you're comfortable that the market might not get there, or it's just on the precipice of where you think it will, then you can receive up to $3,500. We've seen call strikes go for 4,000 before. Things, depends on the market conditions, but it's a lot of premium to receive. And also bearing in mind, it's not just about the market reaching that level, but it's got to go above the break even as well. So if I sell a 30,000 call for 2,000, I'm actually covered and safe until 32,000. I don't start losing any money till then. And then it's very similar to a short FFA position. If the market looks like it's really turning around and rallying hard, it can be managed with either further options. So you could buy higher options to cap the risk, or you can manage it with a long FFA exposure as well. So pros and cons. It's more of an additional revenue generator that can be used elsewhere. The con is it's not really a hedge because it doesn't actually give you any downside cover, but it's a different style of trade. And again, so it would cap the profits if it went high. And in terms of margin, pretty similar again to the short FFA, does have some implications. So I think this slide is quite an interesting one because option leverage is one of the big factors that we sort of promote options. Why use them? Why not just buy or sell the underlying if you know it's going to go somewhere? This is a pretty good slide to answer that. So the whole point of leverage is that the payoff for buying an option or risking a certain amount of premium is that the reward can be multiple times what you're actually risking. That's pretty much what leverage means. It's all about the trader asking themselves, what do I think? What are the chances of this settlement distribution? Where can I see this expiring? Is it going to be over 20,000, over 30,000, over 40,000? How high could it actually go? And should I just buy the FFA or do I look at options? So I put a small example in here. Let's say a trader has 200,000 to invest. There's 3 different option scenarios and 1 future scenario. So sort of actually touches on the option on the margining from the long side. But so if we had $200,000 to invest, we could be buying at the money calls for 70 days, and we would be, I think that's the dark. It's quite a similar color actually, but that's this line. So the first line is just the long FFA here in 30 days, because that's all we can afford with our 200,000, and that's without even including any variation margin. So if the market went against us, we'd automatically have to be stopping out of some volume pretty quick. So options, if we spent on just pure premium, we could be buying 70 days of the at the monies. If we look a bit further out, we could be buying 180 days of the 28s. And if we look out to the 35s, I think 570 days is about 19 fulls of exposure. So if we think about our settlement distribution, what are the chances that the market goes to 40K? I think it's pretty high. What's the actual highest P&L for 200K investment? It'd actually be buying 570 days of the 35K calls. Obviously, if we think the market's going to be around 33.5, we might look here and we might go, okay, well, the 28K calls are the most beneficial thing for us. But that's all about investing, looking at out the money options, the convexity of options versus FFA, and just the volume available. Again, all of those long option positions are not going to have any variation or margin implications. So it's the 200,000 is going to full use. So I've done 5 different trade examples of real trades that we've seen in sort of the last, I think 6 to 9 months, 2 bullish, 2 bearish, and a neutral strategy, with just some sort of pros and cons and thinking from behind both sides. This is a sort of 1x2 call spread, quite a popular trade. It's buying 1 call strike and selling 2 higher up. Again, it's more of a settlement trade, creating a wide range of expiry. It's about people looking at the settlement distribution, thinking where can this market get to? How bullish am I? Typically, we'd look at a 1x2 call spread when someone might be bullish, but they might not be willing to spend silly amount of premium on just an outright call. So how can we mitigate that? We can sell something against it. So this was sort of the market conditions at the time. Obviously, the calendar was a little bit elevated. The whole curve was. With the curve sitting quite high, you know, they might not have wanted to invest it going much, much higher. If anything, what they actually did was, if we look at the market was actually around 21,500. So the strikes they selected, the 2028, they even selected a slightly in the money range to increase the chances of it expiring in the money. This is another use case of options, how it's customizable. You can move things slightly in the money, out the money, to select the range that you want to create, if that's what you're looking for. So buy thesis in that, settlement basis moving up a lot. I looked back at the settlement since 2018. There's actually only settled above 36,000 on 4 occasions, I think across 88 different settlements, which is a little bit sad. So 36K is obviously the higher break even on this trade, i.e. the buyer doesn't start to lose money until it goes above this level. And yeah, and the buyer managed to do it for 0 cost. They didn't spend any premium to place the trade. So if the trade expires, if each month is a complete dud, then they haven't lost anything. And actually, so far you can see January and February, not particularly positive, but it doesn't matter because they haven't lost any money. So, and they've still got the position for the rest of the year, for which sort of 2, 3, 4 is looking a little bit more in line to show a profit. On the sell thesis, the buyer of this trade probably would have traded against someone like a bank or a relative value trader. As like I said, they look to sort of buy strikes and buy options when they can see them that they're underpriced or there's a directional trader against them. So they'll look to do that to sort of book a short-term mark-to-market profit. They might have wanted to be long vol, or they might have been really bullish the market. And obviously, if the market exploded above 36,000, then they'd be long 2 times calls, and it's a winning trade for them. So it depends how they would trade it. Number 2, so also a bullish trade. So in this, we've got outright calls. I think they were Q1 20K calls. I put on here 2 examples. On the left is the simple call payoff diagram that we saw earlier. So we know how to interpret that. On the right-hand side is more of a volatility strategy. If they were to trade the call crossed, i.e. offsetting the delta position with underlying FFA. So if I bought the option in 30 DPM and sold the swaps in 12 DPM and kept a delta neutral position, then I'm inherently going long volatility. This is my payoff. I want the market to move. I don't really care in which direction, but that's what it looks like if I try and keep that delta neutral the entire time. So that's the trade. It traded across the time. How they traded it throughout the life of the option, I don't know. So we'll sort of chat about both. Spot was quite high. Backdays into Q1. Calcium sitting pretty high. So yeah, Q1. So Q1 for options is a bit of an interesting one because it's the lowest underlying across the curve. Generally, in a lower underlying environment, the volatility can be quite high because all the relative moves are a lot smaller to create a bigger percentage move. When the market's at 10,000 and it moves $1,000, it's 10%. If the market's $30,000 and it moves $1,000, yeah, it's much less. So Q1 for options is a period where sometimes people want to be long volatility. So that's a pretty strong reason probably why the buyer bought it. Again, we can sort of refer to this gamma scalping with the calendar at 22,000 and the strike on the Q1 at 20,000. They might think there's a pretty reasonable chance that it sort of goes and moves around there. And yeah, it's just a different payoff. They might have just been bullish and traded it naked and hoped that the market went up. Interestingly, if we actually look at, well, as we know, sorry, from our settlements on Q1, January and February, pretty poor settlements. So in this case, if they bought the strike naked, they'd have lost the premium paid, the $1,700. If they'd have traded the volatility, they'd have actually been in profit down here because the market moved so much and was volatile that it's actually gone outside their break-even range on the downside in this situation. So there's two different ways that that could have been traded. One wouldn't have made money and one would have made money. On the sell side, the seller might have been long FFA already and looked at the approach to short calls as a premium enhancement, as we sort of said for the physical hedging. It's quite commonly seen that people at attractive call premiums. If they sold a 20,000 call at almost $2,000, what's the chances of the Q1 settling almost at 22K? Depends what you think of the settlement range. If you don't think there's any chance of that, then it's not free money, but it might be quite attractive. And they might have just been looking to short volatility. They might have not believed that it'll be volatile at all, and that simple as that. So similar to the example 1, which was a 1x2 call spread, people also look at 1x2 put spreads. So buying 1 put strike and selling 2 lower down. Again, it's all about creating this non-linear payoff range, the settlement range, and reducing the amount of premium for the structure. So if we look at this, they're buying the 27.5, 22.5, and spending how much? Only $580. So it's pretty cheap downside. There's not much risk there until the market goes to 17,500. I think at the time, yeah, the market was fairly elevated. They might have thought it was going to drop, but not drop drastically. So they placed a 1x2 put spread. So it's a realistic downside range, financed by selling 2 times lower puts, less premium spent. Like I said before, with the collar and buying the put and selling the call, went from $4,000 to $2,000. In this case, the person, if they'd have bought an outright put, would have been almost $3,000. So sometimes to mitigate spending premium, people sell other options against it. So in this case, selling 2 brought the premium down drastically to almost a sixth of the price. And yeah, and as well as you can see, the settlements as far as they went. So for October and November, it was quite a positive trade. Settled around 21,000, which is quite close to the sort of sweet spot for this trade. Obviously, December it completely blew out, and because they were short 2 times puts, the market would have down to what, 11,000. So that's the risk with the 1x2 trades. Is if it completely blows out the range, then it's obviously not very happy. The sell thesis for that. So if we return to this to the volatility surface and the skew from earlier, and I mentioned how for freight there's generally a demand for puts. So for this, the seller had an opportunity to buy those puts at maybe a discounted price. That's generally quite attractive. Also, by buying 2 options and selling 1, they're actually buying volatility. They're buying Vega. They might have wanted to go long at the time. So all of these trades, from more of the directional standpoint, basically just provide sort of liquidity for other market traders to trade in and out of other positions, existing positions. Okay, and similar to what I mentioned on the collar earlier as well. So on a collar, we're buying 1 put and selling the call, like I said in the physical example, very similar to the short FFA. This is pretty much that trade, but plus another short put. So instead of obviously not unlimited downside, because there's a floor in the market to 0, but instead they end up selling another put slightly lower down to where they think the market might reach. Not too worried about if it goes much lower. Again, this is just another method for someone to spend less premium on a directional trade, and how it's customizable to create the payoff range. So in this case, they bought a $5,000 downside range, sold it with a 30,000 call. They've actually received money for this trade. So to buy the trade, they've received money. Only a small amount, $250. If we look at the settlement, obviously for July and September, it wasn't in play, but it didn't matter because the market didn't reach their short call strike. There was no risk there. They received a little bit of money, probably covered their costs. And for August, it was slightly in the range and did show profit. Market was fairly flat at the time, so they might not have been completely convinced it was going to collapse, hence happy to sell a slightly lower strike put. Also didn't look like it was going to pop convincingly, so to sell a 30,000 call probably wasn't that dramatic for them at the time. Yeah, so 5K wide downside range. Even if it didn't reach there was no risk because the only risk was above 30. And yeah. So yeah, it's very similar to the collar, the short FFA. But again, you've got the breathing room on the upside, and the willingness to not spend premium. The customizable range is kind of what options enable this player to do. I think they actually put this trade on as a hedge to some long FFA, so that's probably why they didn't want to spend any money as well. And again, for the sellers, they're buying, if we refer back to the smile, and buying lower delta strikes or strikes further away from the money, and how they should generally be marked at a premium. In this situation, they can pick them up for a discounted price, so it's quite attractive for those players. Touching back on the strangle, as we mentioned earlier, buying two options and selling two options. The straddle, if it's a straddle, we're looking at the same strike. If it's a strangle, we're looking at slightly different strikes. Hence, we have the recurrence of the horizontal line in the middle. So again, this is a volatility strategy. Buyer wants it to move dramatically in either direction. Obviously, you probably prefer upside because the market has a floor and there's no ceiling. So if we go to 100K, it's still great. They're paying a pretty reasonable amount of premium, so sometimes you get pretty willing sellers of these again, that also create their payoff range. Actually, for the settlements, it wasn't quite there. So interestingly, so the October and the November, even though they managed to go through the 23K put that they were long, because they had spent so much on the whole structure, they still showed a loss because they only managed to recoup about half of their premium. So this is where the importance of the options are making to the break-even point. So in this case, on the downside, it would be the 23,000, and it needs to go 4,000 through that because they've spent $4,000. They don't show any positive P&L till sub 19. Obviously, the market didn't get there, it got to around 21, so that was why it was negative for October, November, and then December down to 11,000. That's a massive amount through their long put strike. So they had the right to sell at 23,000, and the market settled at 11.5. That would have been automatically exercised, and there would be $12,000 in the money, more or less. Again, strangles and straddles, volatility strategies. So looking for either the market to move a lot or not move a lot. This was the sort of picture at the time with the curve. The index had dropped a pretty large amount, probably about $12,000, which is obviously wider than the actual strangle itself. So maybe the buyer was expecting the volatility to continue. The strangle, because the strikes are slightly further away from the money, we're looking at a $4,000 premium in this situation. The straddle I mentioned earlier was almost $9,000. It's a slightly cheaper volatility strategy for the buyer. That's a fairly logical point. And again, being long slightly out the money strikes, they might just think sometimes people think they're sort of underpriced. So from the seller's perspective, again, we're looking at large premiums. It's very attractive to both vol traders and directional traders. They basically make money between a 19,000 and a 33,000 settlement. It's quite a wide range, and it's a lot of money. So quite attractive. This is the last slide, but I just added these in. So these are basically trades that we've sort of witnessed in the last 2 weeks. Because actually throughout this presentation, we've sort of covered quite a lot of pretty much every available options strategy between call spreads, put spreads, 1x2s, call spreads, 1x2 call spreads, collars, even a put fly. So these are the two strategies that we see quite often, both of a similar ilk. One on the left was placed a couple of weeks ago. It's a call spread versus put spread. It's quite an attractive upside range. We're looking at a fixed upside range of $7,000, financed by a fixed downside range of $3,000. So it always returns back to the fact that when we're looking at options, we can create completely known risk from the start. It's limited to we know what our maximum downside is there. We know where it starts. We know where it finishes. We know where we want the market to go. It's all pretty black and white. So that's quite an attractive thing. Again, still about options. On the right-hand side, slightly different. Instead of just an upside range financed by a downside range, it's just financed by the put. So the buyer here is probably more convicted that the market on Panamax wouldn't go sub that level, and they were happy to do that. I mean, they could have equally have probably traded a 12.15 call spread versus a 9.7 put spread and paid $500. But they probably didn't think that was necessary. So two different ways of trading it, but fixed ranges, fixed losses, and known risk, combined with sort of options leverage is some of the main use cases why we see the traders come in and trade every week. That's pretty much me done on my part.